You are listening to The Investor Way with Sam Ball and Jonathan McEwen. If you enjoy the show, please subscribe and follow us on Twitter at TIWTweets.
Hello, welcome to The Investor Way with me, Sam Ball. It's the 2nd of March 2025 and I'm joined by my co-host John McEwen. In this week's episode, we'll be discussing Nestle, Smith & Nephew, BAE Systems, Mony Group, Centrica, and it's not US this week, but I guess I can't even say our foreign company of the week because Nestle is also foreign. But what would normally occupy the US slot is now our Chinese company of the week, Alibaba. I think it's listed in Hong Kong, by the way.
Okay.
But it did list in the US in 2014 on the New York Stock Exchange. I do sort of have it vaguely in my head that at some point it moved. So maybe that's what happened. But at one point, US listed company of the week is Alibaba. John, do you want to start us off with Nestle?
Yeah, so a Swiss company and owner of Nescafe, Nespresso, Kit Kat, Purina. It's got huge portfolio brands and it's Europe's largest consumer goods company. They had their full year results out with full year sales falling by 1.8% to 91.4 billion francs, and currency was a detractor with underlying growth of 2.2%. Volume improved by 0.8%, with prices up 1.5%, both being better than expected. Growth was led by coffee, confectionery, and pet care. Operating profit fell to 15.7 billion Swiss francs from 16.1 billion, and free cash flow was 10.7 Swiss francs, which is an increase of 2.5% from the previous year, helped by reductions in tax payments and capital expenditure. Net debt increased from 49.6 billion Swiss francs to 56 billion. Organic sales growth is expected to improve in 2025, and underlying operating margins are expected to be around 16%, compared with 17.2% last year, and that was due to a ramp up in investment spending. Nestle has proposed a 1.7% increase in the annual dividend to 3.05 Swiss francs per share, and the shares were up nearly 6% in early trading. In terms of valuation, Nestle has a market cap of 228 billion Swiss francs, which is around 200 billion pounds, and trades at 17.3 times forward earnings, compared with a 10-year average of 21.4, and it has a prospective dividend yield of 3.9%. And it's also worth mentioning that it does have a 20% stake in L'Oreal too. I thought these results were a bit disappointing, but probably broadly in line with expectations. It's been a difficult macroeconomic environment, and it's been on the back of heavy inflation in 2021, 2022, and significant price hikes. So I don't think it's entirely surprising in that context. Out of the consumer goods companies, though, Nestle has historically, in the past sort of 5 years, probably been the strongest performing of them. And I think you are seeing that coming off a bit now. They do actually have a new chief executive and obviously trying to get back to more significant volume growth. I think for me at the moment, Nestle wouldn't be my pick. And on the back of going to Fundsmith the other week and hearing about Terry Smith and the Fundsmith's team's take on the change at the top of Unilever, they were actually very positive. So I think in terms of the portfolio of brands, Unilever and Nestle, I would say, are probably about on par. But I think there's probably a bit more momentum with Unilever at the moment. And actually, the change at the top may be a positive one. They really rate this new chief executive, Fernando Fernandez, very highly. So I think that is quite interesting, and probably a reason that I wouldn't be buying Nestle at the moment. Sam, what are your thoughts on these results from Nestle?
I think the results are disappointing. I'd echo what you said about, certainly in the time we've covered Nestle on the show, it probably has been the strongest performing consumer goods company. And these results are just a bit disappointing. But I think the price is now looking a lot more reasonable, because it was a stock that, again, the whole time we've covered it, it's kind of been around 20 to 25 times earnings. It's now down to 17 or 18, which is pretty reasonable. And it's now in line with Unilever. But I think the issue is, like you say, Unilever now, it does feel like there's more cause for optimism. It's moving in the right direction now. They have just had a good year under the outgoing CEO. And I think the only uncertainty we had, like you mentioned, was that change at the top. But Terry Smith and his team were very, very positive on the CFO that's taken over. So, yeah, I think it's interesting. I think Nestle is maybe now at a more reasonable level than we've ever seen it at. What I'd be interested to know, though, is it's the kind of company that I think would sit very well in your portfolio when you look at what else is in it.
Yeah.
It's now trading at a very similar price to Unilever for the first time since we've started covering them.
Yeah.
So I do wonder, it can't be that far off a price at which you'd be quite interested in it, I'm assuming.
It's probably not, and it's probably about that price now. I think it does show the psychology in it, because when you see that stock, that not that I ever sort of disliked Unilever, but it had definitely lost its way for a good 5 or so years, and then it's getting some momentum back, and the bias is there. And now I'm less keen on Nestle now that Unilever's got a bit more momentum with it. But yeah, it's a very good point, and probably one that I should consider. And whether I start a position in Nestle, I may well do.
Should we move on to a debut on the show?
Yes, so Smith and Nephew, and it was a listener request.
It was by Pat. So, Smith and Nephew, it is a debut on the show, so I'll just cover what the company does first. They are a portfolio medical technology business focused on the repair, regeneration, and replacement of soft and hard tissue. They exist to restore people's bodies and their self-belief by using technology to take the limits off living. They operate in more than 100 countries worldwide. They develop and produce pioneering products across their 3 business units: advanced wound management, sports medicine, and ENT and orthopedics. So the first segment is advanced wound management, and that has a global market size in 2023 of $11.4 billion, and all the figures it reports in are dollars, and that was up 5% for 2023. And they are the second largest global advanced wound management business in terms of revenue, with the broadest product range. And in the advanced wound care subsegment, they compete with a Swedish company, Molink, and Convatec in the UK. And in advanced wound devices, they're the primary challenger to negative pressure wound therapy incumbent 3M. In their advanced wound bioactives franchise, they have leadership positions in their respective categories. Where they're second in advanced wound management, it looks like they have a 14% market share compared to 16% for 3M. So they're a close second. In sports medicine in 2023, that had a global market size of $5.8 billion, which was up 7%. And they are the market leader. Oh no, second again. 28% compared to 33% market share for Arthrex. And they also compete against Stryker and Nephew. And in orthopedics, hip and knee implants, the global market size in 2023 was $15.9 billion, up 8%. And the fourth biggest with a 10% market share. I do think it's probably worth a mention, but hip and knee implants, you think with aging populations, that's a market that's probably going to grow quite a lot. And so they have come out with their full year results, and full year revenue grew 5.3% in 2024 to $5.8 billion on an underlying basis. Growth was broad-based across divisions and regions. Total revenue was slightly ahead of the previously lowered guidance, and that's also the case for underlying EBITDA/trading profit margins, which improved from 17.5% to 18.1%, with cost savings and scale benefits more than offsetting inflation and pricing pressures in China. Overall trading profit grew 8% to $1.1 billion. Free cash flow increased from $129 to $551 million, benefiting from a significant improvement in cash generation from operations, as well as lower capital expenditure. Net debt decreased marginally to 2.7%. Looking ahead, China headwinds are expected to constrain underlying revenue growth to 1 to 2% in the first quarter, with around 5% expected for 2025 as a whole. Full-year underlying trading margin of 19 to 20% is anticipated, and that's going to be weighted towards the second half of the year. The dividend was unchanged from the previous year, and the shares rose 5.5% following the announcement. It looks like they have had issues recently with the Chinese market because China have started buying their medical devices in bulk, which has driven down the prices that Smith and Nephew can charge. And in terms of the valuation, the business trades at a forward P of 12.4, and that compares to a 10-year forward P of 17.8. And the prospective dividend yield is 3.1% compared to a 10-year average of 2.3%. I think it's a fairly interesting business. So I think the issue is it seems like the orthopedics division, I get the impression that's the one that's maybe been performing the most disappointingly, but it's probably also the one that you would think is going to have the best long-term tailwinds with aging populations. At forward P of 12.4 and a decent dividend, I don't think it's that expensive. And if it's now getting to a point where they're expected 5% revenue growth for 2025, and hopefully, if they've turned things around recently, that could be a bit higher in future years. The issue I've got is as soon as we get into like medical technology and stuff like that, I don't really know enough about it. I suppose I don't know if it's less of an issue or more of an issue, but they're not the market leader in any of the markets in which they operate, which is probably a bit concerning. So there's if they're number 2 or number 3 or even number 4, I think that suggests there's not a moat there, because if there was, there might be number 1 instead. So that's a concern. And I just think it's a business that operates in an industry I know very little about. John, I do wonder if you know slightly more about it. So do you have a different take?
I mean, I think the point you make about orthopedics and the long-term tailwinds with an aging population is a very good one. I think it's interesting from a value perspective, and it might be a case of us looking at some of the other ones in future shows, like Stryker, for example, because I think Stryker trades at about 50 times earnings, and this is well down on that. I appreciate Stryker is, a market leader, and it does look like there are activist investors around Smith and Nephew, and they're keen to try and unlock some of the value. So whether that means spinning out parts of the business, I'm not sure. But I think probably if we got a bit more idea about the sector, that would allow us to perhaps make more of an investment case for them, or at least to ourselves. I think it's probably less difficult to understand than some of the pharmaceutical companies for sure. But again, it's the only one we've ever looked at. So it might be that we just broaden things out a little bit and look at some of the other players in there.
But Stryker's US listed, isn't it?
Well, it is. But I mean, we do cover US listed companies.
We do, but the issue is as soon as you said 50 times earnings.
Okay.
I mean, we can cover it, but my instinct is kind of, well, I'm not going to be buying it.
Yeah.
So there's an element like maybe we'll come back around to Smith and Nephew in 6 or 12 months or something and understand it a bit more slowly. But the issue is the orthopedics is, I'd say, the most interesting part of the business, but that's the one where they've only got 10% market share.
Yeah.
So it's the one where they're the smallest player in terms of their position in the 3 markets they operate in, whereas that's the one where you'd really want them to be a bit higher up.
It is interesting, but I think we'll definitely come back to it. And I think it probably would be worth having a look at, even if it's just to put Smith and Nephew into a bit more context, to have a look at some of the others.
Okay. Should we move on to BAE Systems?
Yes. So we've covered it a few times on the show. It's the largest defence group listed in the UK. And they had their full year results out last week, with full year sales rising 14% to £28.3 billion, ignoring exchange rate impacts. And performance was helped by the integration of new space and mission system business, formerly Ball Aerospace, and all divisions were delivering growth. Underlying operating profit moved 14% higher to £3 billion at the top end of the group's guidance range. The order book grew by £8 billion to a record £77.8 billion. Despite falling by around £100 million to £2.5 billion, free cash flow was well ahead of guidance due to early receipt of payments from new customers. Net debt rose from £2.4 to £6.8 billion as a result of debt being raised to help fund the acquisition of Ball Aerospace. In 2025, sales and underlying operating profits are expected to grow between 7 and 9% and 8 and 10% respectively. Final dividend of 20.6 pence takes the full year total to 33 pence, which is up 10%. And the shares were broadly flat in early trading. So I think with BAE, there's certainly a lot to like at the moment, but it's also reflected in the valuation, with a current market cap of £42 billion, trading at 17.6 times forward earnings, compared with the 10-year average of 13.3, and it has a prospective dividend yield of 2.7%. So yeah, I think very good set of results. They've got huge R&D costs, though, with the long-term projects like fighter jets, the aircraft, submarines. And I think that the forward visibility for that is very good. And if you were to take the argument that there is likely to be world tensions in the next 10 to 20 years, then whilst you'd say it's a cyclical business, we may not be right at the top, or at least we may see good numbers and more, largest shares of GDP in countries across the world being invested into defence, which obviously benefits BAE. And BAE is pretty global, although 50% of the sales do come from the US, so it is dependent on that for half of its sales. I think also, the order book at the moment huge. So whilst the R&D costs are high, as I say, the forward visibility is very good. I think for me, what would put me off is that it is a very capital intensive business. And even if you were to take a sort of negative view on the world and say that the tensions are likely to be raised for a while, probably would be looking elsewhere. I don't think it's the type of business I would be looking to buy, but I don't think you can knock this set of results. Sam, what are your thoughts on BAE Systems and the full year results?
Pretty similar. I think it's similarly priced to the last time we covered it, which is a lot higher than it was probably the time before that. It did trade at a much lower valuation for a long time and had a number of outstanding issues, which it seems to have gotten on top of. I think it's probably more attractive than it was last time we covered it, because I think in terms of sort of macroeconomic factors that have happened since then, and countries announcing increases in the percentage of GDP that's going into defence spending, I think that's probably there's quite a small number of companies that can benefit from that realistically. If me and you want to create a startup that's going to make nuclear submarines, I think we struggle to win any contracts. It's very high barriers to entry. So I think because of that, it's probably, although it's a similar valuation, I think it's probably more attractive than the last time we covered it. However, I think you would be at a point where there's firstly an awareness that it is still a cyclical business. I think it's just got too much dependence on probably macroeconomic factors, which I don't really like as a concept. I think I'd want to be buying a business because it's a great business, not because the amount of GDP that's going into defence spending is going to go up. I kind of feel like, although that's going to benefit BAE, and that's, it is a good business, and that's not the only factor to consider, but I think it's quite a key part of the valuation now, and that would just make me very uncomfortable, because if I look at my own track record of macroeconomic calls, I've been very, very bad at it, so it's probably just best to leave it alone. But I think it does look like a good company, and I think you can make an argument for it.
Yeah. Okay, fair enough. Shall we move on to our next company?
Yes, and it's a company that I own, so it's Mony Group. We have covered them multiple times before on the show. They have come out with their preliminary results for the year ended 31 December 2024, and revenue for the year was up 2% to 439.2 million. Adjusted EBITDA was up 7% to 141.8 million, and when you actually look at the adjustments they've made, the adjustments were they've removed amortization of acquisition-related intangible assets. That's, I think, kind of fair enough. They've removed irrecoverable VAT provision and related costs. That's actually, I've got more of an issue with that, because I kind of think, yes, it's unusual, but you get these sort of unusual things pretty regularly. So I'm of the nature it should be left in, but it's only £3 million, so it doesn't hugely impact the positions. Yeah, so the adjusted EBITDA was up 7% to 141.8 million. Profit after tax was up 11% to 80.2 million. Adjusted earnings per share was up 5% to 17.1p, and basic earnings per share was up 11% to 15p. Operating cash flow was up 13% to 115.6 million, and they've gone from net debt position of 19.8 million to a net cash position of 8.4 million. And the dividend per share was up 3% to 12.5p. So their record revenue was driven by good performance in insurance, particularly in the first half of the year, as well as growth in the newer cashback division. and the return to net cash was due to paying down the term loan for the Quidco acquisition. They have announced a share buyback program of up to £30 million, which reflects their strong cash generation and robust financial position. During the year, they helped households save an estimated record £2.9 billion, and they've had strong momentum across their members-based propositions, with the Super Save Club surpassing 1 million members with all major products live, and members now generate 12% of group sales. In terms of the outlook, they've said despite headwinds in the car insurance switching market, strength in our breadth provides us with resilience, and we continue to see other opportunities for growth across the business. And if we break down the Q4 results by division, insurance revenue was up 2%, despite premium inflation in car and home returning to more normal levels, with travel and life performing particularly well. Mony was down 2% in the quarter due to fewer attractive current account deals. Borrowing continued to grow, driven by improved credit card switching volumes. Home services growth was flat in the quarter, with some improvement in energy switching helping to offset continued challenges in broadband and mobile from provider retention strategies. Revenue from travel fell 6% in the quarter, with performance slowing in a competitive market. And travel insurance is now included within the insurance segment of the business, not travel. Cashback revenue was flat in the quarter, with strong performance in insurance offsetting softer trading in retail. And if for the year we look at the revenue as a whole, the total revenue of 439 million, of that 235 million was insurance, so over half. 97.8 million was Mony, so nearly a quarter, probably like 20%. Home services was only 36 million, and travel was 19.6 million, and cashback, which was the newest division, that is 60.8 million. So it's probably about 15% of revenue, which is pretty decent. And then there's 10.7 million for inter-vertical eliminations. So in terms of the valuation, the business trades at a PE of 11.43, and it has a dividend yield now of 6.4%, which doesn't include the buyback program. I'm very happy with these results as a shareholder. I think the way they have responded to basically the energy section of the business pretty much shutting down has been excellent. I think that's gone on for long enough now that it's probably just have to proceed on the basis it's not coming back or anytime soon. And if it does, it's a bonus. But I think the way they've gone out and acquired Quidco and built up that cashback part of the business, I think they've done an excellent job. I think it's still quite nicely diversified. It's got a very high return on capital. It churns out cash. The only complaint I have about this business is that I think there's quite a few opportunities to reinvest it, which is why that yield is so high and they've got the buybacks. So although the return on capital is very high, they can't reinvest that capital within the business, unfortunately. But I think the business is so good and the returns are so good, given the valuation, that I'm quite happy to just take my 6.4% dividend, which is being reinvested, and just keep on buying shares in it, because I do really like this business. John, as someone who does not own shares, what do you think of the results and the valuation?
Yeah, no, I mean, I think the results are pretty decent, and I think the valuation is fairly lowly. I guess the question is, where the future growth comes from. And I appreciate, as you say, it's churning out quite a lot of cash, but perhaps those investment opportunities within the business, maybe there's limits to what they can do with that. And then, as you say, they're returning that to shareholders. I'd probably be looking for more growth, and that might be a reason for not buying it. But I appreciate current valuation and how it's doing overall is pretty good, and that can't really be knocked.
I think in terms of the growth, I do take your point, and I do broadly agree, because it's hard to argue with it, because management actions speak volumes. If they thought there were opportunities to grow, I think they'd be keeping more cash. I would counter it slightly by saying that, we could have said this about the business a couple of years ago, and they went out and did the Quidco acquisition, which has worked incredibly well. So I think, although you're probably going to have to assume there's not going to be a huge amount of growth, I think if an opportunity comes along or the right acquisition, I think management have shown they'll take advantage of it. So you might get something, but you probably have to view it as a bonus. I wouldn't factor it into the thesis that they might go out and acquire something.
Yeah, no, absolutely. Fine. Shall we move on to Centrica?
Yes, a business that you used to own?
Yeah, I can't remember exactly when it was sold, but it must be getting on for 2 years ago now. So yeah, it's one that I actually bought around the time when the energy price cap first came in, and it's about, I don't know what it was, it must have been about £1.60, £1.70 a share at the time. I thought that was quite good value. But anyway, that became more restrictive and government intervention stepped up a few notches since then. Anyway, it's, for anyone who doesn't know, it's the group that owns British Gas and Hive. They had their full year results out with revenue falling by 25% to £19.9 billion, driven by lower commodity prices and price volatility. Underlying operating profit dropped by 44%, but this was still better than the market had forecast. And the decline was due to a fall in revenue and the previous year's one-off cost recoveries of £500 million being non-recurring. Free cash flow fell from 2.2 to £1 billion as a result of the lower profits and increased capital expenditure. Net cash has improved from 2.7 to £2.9 billion. And for 2025, all retail energy supply and optimization businesses are expected to deliver underlying operating profits within their medium-term target ranges. And British Gas Services and Solutions is expected to reach its medium-term target range by 2026. Full-year dividends were up 12.5% to 4.5 pence per share, and a further £500 million of share buybacks have been announced. And the shares were up about 8.5% in early trading. In terms of valuation, Centrica has a market cap of around £7.5 billion and trades at 1.53 times forward price to book, with a 10-year average of 2.6, and it has a prospective dividend yield of just under 4%. I mean, I thought these results a bit disappointing, but they really can't change a lot given the cyclical nature of the business. They've got a huge amount of cash now compared with historically. Some of the historical pension issues have been dealt with. And I think as a business, they're in a much healthier state than they were 5-10 years ago. The difficulty is that the industry has changed a lot in that time. Some things that they benefited from was after the war in Ukraine, that energy prices were much higher. So that was something that they hadn't done anything to plan for, but they did very well out of it. On the downside, there has been much more government interference and regulation in the market. And when the price cap came in, British Gas historically had a lot of people sitting on the standard variable rate tariff, which was a bit of a rip-off. And then essentially since that has been capped, and there was increased switching too, but the combination of those two really did for that side of the business. And from being very profitable, it was really cut right down to size. It also had the impact of destroying a lot of its competition. So some of those pop-up energy companies which increased competition in the market weren't very well run. And when prices went up pretty significantly over a short period of time, they were all destroyed. But what you're left with is not a hugely profitable market with that government interference and those price caps. I sold my shares a couple of years ago when I felt that it had just got to a level where it was going to be very difficult to make any profit. And certainly as the business was doing better, that it was going to be the target of extra taxes. So I felt it was politically too hot to handle and hence sold it. I think for that reason, I wouldn't go back in, and it kind of ends the investment thesis there. When I initially bought shares, I know I mentioned it was around the time of the price cap. I had them for, I think it was about a year. And that was a year before the price cap came in. And initially, I think under Theresa May, it didn't look as bad as it might be. But then that was proved to be wrong. And it did just get tighter thereafter. So whilst it's a very cheap business, I wouldn't be going near it. Sam, what are your thoughts on these full year results from Centrica and the investment case for the business?
I think the results are disappointing, but I think there's very little they can actually do about them. I think it just kind of rises and falls with the energy prices, really. In terms of the investment case, I think for the reasons you've outlined, it is uninvestable. So Yeah, it's probably the industry with the most government intervention. And I think as a consumer, I'm very pleased with that because I think, for anyone that was on, like you say, on a variable tariff, they're much better off. But as an investment case, it's not good. And then I think even then, the PE is like nearly 8 and the dividend yield, the prospective yield's under 4%. But it's not really a business I'd expect to grow. I think there should probably be a discount given the amount of government regulation. So I think for the yield you're getting, given that you can get that in a bank account or you can get it in gilts pretty much risk-free, I'm not sure why you would want to buy it anyway, because I would expect it. I think a P of 8 is not awful, but given the government intervention, maybe it's just too. I'd probably want to see it like sort of 5 times earnings or something. And I appreciate that's really cheap, but I think the discount for the potential intervention, because if they ever have a good year, they're just going to now get smacked with an excess profits tax. I think they should trade at a serious discount, and it just doesn't, which I find a bit bizarre.
What do you think about the cash they're sitting on?
Ooh, that's a good point.
The net cash is about 2.9 billion at the moment.
On a market cap of 7 point. Ooh, yeah, that is a good point. Yes, that could be why. But then why are they sat on it? Why don't they just... I suppose maybe it's because politically, if they release it all in one go, it's going to be all over the newspapers, but maybe you'd be more likely to get away with it if you announced a share buyback.
Yeah.
Whereas a dividend, that's going to be... The Guardian will be all over that.
Yeah.
But yeah, but it's an example of why it's so uninvestable, because actually getting that cash to shareholders in a politically neutral way, I think is quite difficult.
Yeah, I think it was definitely when I bought shares, there was more appeal to it in that you had ultra low interest rates and they were paying out kind of a reliable 5 to 6%. So you weren't at that time getting it in a bank account.
Yeah.
So it was more of a bond proxy type argument.
Yeah, I'd agree with that. Shall we move on to former US listed company of the week?
Yes, Alibaba.
So it is a business we've covered before. I think it was a couple of years ago, at least last time we covered it. However, they have come out with Q3 results and revenue rose 8% to $38.4 billion. And all these figures are in dollars, and that was ahead of market expectations. All divisions except logistics contributed positively, with international e-commerce growing at the fastest pace, up 32%. Alibaba Cloud grew 13% in the period, helped by triple-digit growth from AI-related products. Underlying cash profits rose 4% to $7.5 billion, as growth in the top line and efficiency improvements were partly offset by increased investments in e-commerce. Free cash flow fell 31% to $5.3 billion, largely due to increased investments in cloud infrastructure. There was a net cash position of $23 billion at the period end, and the group completed $1.3 billion of share buybacks in the quarter. The shares rose 8.2% in pre-market trading. They have also seen membership numbers in their loyalty scheme, the 88 VIP Club, swell to 49 million, and the business trades at a forward PE of 13.2, and that compares to a 10-year average of 20.1, and there's a prospective dividend yield of 1% now, actually. And where I said the shares rose 8.2% following the announcement of results, they subsequently issued an announcement that they were intending to invest at least $53 billion over the next 3 years to advance its cloud computing and AI infrastructure, which is a very steep increase compared to market forecasts, and shares fell 10.2% following that announcement, so it's kind of gone up and gone back down. I don't know how I feel about it. I think it was, last time we covered it, it was much more of a value play. The shares had done very poorly. They seem to have started to recover a little bit. The main issue I would have with it is firstly that it's Chinese, and in terms of the governance, I don't feel like you really have the same rights as, I know you technically do, but I think there's a huge element of risk that you don't get with a company operating in the US and Europe. And that's partly why it trades at such a low valuation. People might have said, well, it was trading at such a low price that it's worth that risk. And I think there's a strong argument to that. But I think if it's essentially a value play at this point, those huge investments in AI infrastructure are a bit concerning, because that's all the cash piles gone. There's not going to be huge amounts of returns to shareholders. And then as well, the AI needs to really, I know it's growing triple digits, but it needs to really perform to justify that investment. So I think if I'd bought shares, which a lot of people did, I think when it was trading at much lower valuations, I think the AI investment combined with the fact that it's a Chinese company, it would be enough for me to be feeling quite nervous, and I'd probably seriously be considering exiting at this point if I hadn't already. Terry Smith got a question about big tech at the Fundsmith meeting, and he'd made the point that like the capital investments are now making in AI, and these were the American ones, but they were all they were actually investing much larger figures because they were in the hundreds of billions rather than just 50 billion. But these figures are so large that the AI businesses need to really, really perform to get the kind of returns that investors are used to. And it's not obvious they're going to do that. So yeah, for me, I think it's a good company, but there's just a lot of concerns I would have, and I just wouldn't be comfortable owning it. It's a stock that I wouldn't sleep at night while holding. What about you, Don?
Yeah, no, I would tend to agree with you. And I think the political risk of it at the moment, I think, would probably be too much to look much further, to be honest. But valuation, I guess if you're comparing it with, Amazon and US peers, you can see that it does trade at a discount, but for good reason.
So of these 6 businesses then that we've covered this week, Nestle, Smith & Nephew, BAE Systems, Mony Group, Centrica and Alibaba, which do you like the most and which do you like the least?
I'll go for Nestle as my first, which probably is telling me something. And last, be between Centrica and Alibaba. I'll probably go Alibaba because I think, I go for Alibaba.
My number 1 would be Mony Group, which is a good sign because it's the one I own. My least favourite, I think, would also be Alibaba. And again, like you, it was between Centrica and Alibaba. I think both of them have issues in relation to government intervention. But I think the worst case scenario for government intervention for Centrica is a lot less bad than the worst case scenario for Alibaba, which is why Alibaba goes to bottom. I think because of that, it just kind of makes it uninvestable for me.
Yeah. All right. Well, thank you very much for listening, and we'll see you again next week.
See you next week.
Thank you for listening to The Investor Way. To get in touch, please follow us on Twitter at TIWTweets. This podcast is for entertainment purposes only and does not constitute financial advice. Neither Sam nor Jonathan are financial advisors. For investment advice, please consult professional advisors.